we're not the right folks for some people. We are not transactional partners. We are not a group of CPAs and attorneys trying to sell you ink on a sheet of paper, because that's what you've got right now in a majority of the planning industry, not just in crypto, also outside of cryptos. You've got transactional folks trying to say, hey, you need to set up a charitable trust, or you need to set up a revocable trust. Let me set that up for you. You pay me and I'm going to slide this piece of paper across the table. You slide the check over, and then I'm going to move on to the next person. Good luck. This is our first webinar. We actually had to hop off because there's so many folks that dialed in. Apparently, we reached some streaming limit and had to quickly update our subscription into so that y'all could all stream in and listen in today. So good morning, afternoon, evening, depending on where you're at. I'm Blake Schaper with Mountain Crypto Advisors. Excited to speak with you all today about who we are, what we do, and whether or not we're a right fit for you. I kind of joke saying, morning, afternoon, evening, but the reality is we've had folks literally all over the world calling in, folks in Europe, Philippines, South America, Japan, and of course the beloved Puerto Rico, looking for planning. And what's resonated throughout all those conversations is that you all as a community, when I say you all, Hexicans, Pulse folks, but also just folks within crypto at large, are really in need of planning, of some things that we've done a lot outside of crypto, and all MCA is bringing that service to crypto. So I'm not going to go into the weeds on a lot of the planning strategies today. We could literally spend an entire week talking about all these different trusts, how they are incorporated into a plan, and what they do. It's important for the community to understand at a high level what they do, but instead of going through 10, 15, 20 different possible trust or tax strategy solutions, we're going to really focus on what we're trying to accomplish through MCA, what the planning objectives are. And then we'll have a more nuanced discussion if you decide to progress forward on what vehicles and strategies we employ in order to meet those objectives. But before I get into the weeds there, let me just tell you about who we are and how this all got started, just for context. And I apologize for any of the folks on the stream right now that have already had their initial consultation call, because some of this is going to be a little redundant to what we've discussed in the call. In a lot of the calls, I give a little bit of background just so the person on the call knows who they're talking to. And this background may be a little redundant to what you've already heard if you've had your call. 6-7 months ago, we didn't plan on doing any type of planning with cryptocurrency. All of this came out of a Hexican showing up on our doorstep. And whether you call that fate or coincidence, a Hexican showed up on our doorstep with a tax problem. And that tax problem was one he couldn't solve by interviewing 20, 30 different CPAs and attorneys. He showed up looking for someone to help him out. And when he showed up, we told him, we were like, hey, we haven't dealt in crypto heavily, but here's what we've done outside of crypto. And what we do outside of crypto is manage money for very, very, very wealthy people, decamillionaires and billionaires. Me and my much older business partners have done that for a while. And it's not just a strategy focused on investing assets for those type individuals. It's the one-stop shop for all their planning, the tax planning, the investment strategy, the insurance planning, the legal planning. So we explained to this Hexican who showed up, was like, hey, we do some pretty cool stuff outside of crypto in a creative and innovative way. We just haven't done it within crypto. And we started working with him. He was the genesis of what came to be Mountain Crypto Advisors, because as we worked through his planning, he found that he had found a team rather than an individual that was trying to sell him a trust or a tax return. He had found a team that was going to not only set the plan up, but be with him for the long haul. And that's what we are. And that planning, that interaction led to a conversation with a lot of the folks within the discourse syndicate realm. And the initial call with them, I think it was RG3 and Kinetics, who I spoke with first, was just really focused on, hey, here's what we do outside of crypto. And those folks ended up, getting really hyped up about finding a planning solution for the community, that they flew down to this small town in Hartwell, Georgia for a weekend. And we spent the entire weekend just focusing on the planning that we do and how it might be tailored to benefit the crypto community. And that was where MCA started, literally built entirely around crypto, and more specifically around Hex and Pulse. So I to say we're unique is one thing in the regard of being a one-stop shop for crypto, but I don't know there's another company that exists in the world that built themselves specifically around a particular community of crypto. That's what Mountain Crypto Advisors is at the end of the day. But we're not the solution for all of your planning needs, depending on how you are aligned philosophically and what you're looking for. We're not the right folks for some people. We are not transactional partners. We are not a group of CPAs and attorneys trying to sell you ink on a sheet of paper, because that's what you've got right now in a majority of the planning industry, not just in crypto, also outside of cryptos. You've got transactional folks trying to say, hey, you need to set up a charitable trust, or you need to set up a revocable trust. Let me set that up for you. You pay me, and I'm going to slide this piece of paper across the table. You slide the check over, and then I'm going to move on to the next person. Good luck. When we sat down with the Discourse Syndicate folks a few months back, when I was alluding to the meeting, that was one of the first things we talked about, is we are not transactional partners. We're not trying to sell ink on a sheet of paper. Our involvement is not just in getting the plan set up. It's in being involved ongoing when the plan needs to change or your life circumstances change, whether things inside, outside of your control affect the plan, making sure it's adapted to those changes so that it's effectively tailored to your goals and objectives. And that was one of the criteria that Discourse Syndicate, as they were vetting teams, really highlighted. Hey, we're not trying to work with folks that are transactional. We want to bring to the community a strategic partner that's involved ongoing. And that's what we are. Now, little did they know at the time, that's exactly what we do outside of crypto. And we're just retooling that for crypto. But that was the impetus of what came to be Mountain Crypto Advisors and how we view ourselves. And if you're looking for a transactional partner, we're not the team for you, because you can go out and hire a lawyer to draft you a trust or a CPA to do your tax return. Good luck finding one that actually understands crypto, and more specifically Hex and PulseX, but you might be able to find one that understands it. And I'm sure there's plenty of lawyers out there that are happy taking your money to, again, sell the ink on the sheet of paper. We're just not those folks. And I've had calls with folks that have been, I think, a little uncomfortable for them, because I'm very transparent about that, even on the calls. If that's what you're looking for, whether it's now or during the initial consultation call, that's clear. I'm going to tell you, hey, I don't think we're the right partners for you. But if you're looking for a team that's embedded into your planning for the long haul, and I'm not just saying, for the next few years, and I'm not just talking about doing your taxes, I'm talking about proactively communicating with you as you make really big decisions over the next year, 5 years, 10 years, and so on, and even bridging into the next generation. That's the type of team we are. That's what we've done for a long time outside of crypto. Again, we're just retooling that same strategy and bringing it to crypto. And a lot of the vehicles that we're setting up in order to effectuate that plan, they're not rocket science. These trusts that you see on, YouTube, people talking about charitable remainder trusts, asset protection trusts, revocable living trusts, they've been around for decades. They're time tested. And if anyone's trying to tell you that they're overly complex and it's the next flux capacitor, that's pretty much bullshit. They're not. A lot of the trust documents you'll see from one lawyer to another look pretty similar. Now, I'm not trying to overshadow the fact that, there are technical concerns and considerations that go into building an appropriately drafted trust or appropriately planned tax strategy. But at the core, these vehicles, you could go to any attorney, and they could go into their legal software and type in charitable trust, and it will spit out a template for you to put your name in. Again, that's not the type of folks we are. And it's important that you're not just trying to get the documents drafted and set up, but you're actually focused on how those documents move towards execution of the strategy. Because about 5% of our energy realistically goes into setting up everything. All the trust, business, how all this integrates. And I know that's very unclear right now. We're not going to get into all the weeds on it, but there's a very clear architecture once we're done on how these different buckets work with your plan. But 5% of our energy goes into that. 95% is everything that goes into the planning after that. The conversations we have prior to large stakes coming due. Hey, you got $1 million stake coming due, hypothetically, next month. Let's talk about where that money's going to go. You want to buy a piece of rental property or a vacation home. Let's talk about how you own that to keep it private and protected. Let's talk about how you buy it, whether you finance a portion of it so it has some inherent asset protection through a lien, or if you buy it outright. And then with what's left over after you bought those things, let's talk about how that cash is deployed through an investment strategy that's aligned with your goals and objectives to produce income. Because a lot of folks within the crypto realm are really focused on creating an income strategy once they off-ramp to fiat. And it's the same thing we find on the non-crypto realm. All these folks that have taken a tremendous amount of risk, y'all's risk is more within crypto itself. Folks on the other side of the fence is generally more in business risk. They look to, as they off-ramp from the business into fiat and into their trust, create a strategy that's focused on capital preservation. So really diversifying their risk, but also income production. So they have a stream of income that's either a supplement to their income or a replacement to their income if they plan on exiting the business. Those are the type conversations that we'll have ongoing, because we don't know what, the next month, 6 months, year, next 5, 10 years obviously is going to look like. And that's why we are committed to staying involved, not just getting the plan set up. So hopefully that paints at least a macro level view of who we are philosophically, so you can make a decision on whether or not you're philosophically aligned with that approach. And if you're not, that's perfectly fine. We're always going to be transparent with who we are, what we're trying to accomplish. And if we feel it's not in your best interest or aligned with your goals and objectives, we're going to tell you. Again, not going to get too much into the weeds on the specifics, but I do want to talk about what we're trying to accomplish with our planning. And there's a lot of parallel. Again, we're going to see this throughout the conversation between what we're planning for in the crypto realm to what we've planned for in the high net worth realm outside of crypto. Because believe it or not, you all being high net worth folks, whether you're high net worth now or you are a month from now, 2, 3, 4, 5 months from now when PulseX launch and your bag is inflated tremendously. There's a lot of similar concerns that folks in the crypto community have with folks outside of the crypto community. And one of those, just to start at the top, and this isn't necessarily an order of precedence, but one's privacy. One is, how do you buy stuff? How do you off-ramp in a way that is very private? And as you purchase things after you off-ramp, keeping those assets private. What you'll find within the high net worth community outside crypto is the first line of defense of true asset protection, keeping the target off your back as a liability target, getting in a fender bender and being sued for millions of dollars because they find out you got money that they can take. The first level of defense is privacy. Rich folks don't like the community, the world knowing what they have. So there's very deliberate planning strategies and structures that go into keeping what you have private, especially as you off-ramp to fiat and roll cash into assets, whether they're income generating assets or just lifestyle assets. The emphasis on privacy is critical. And it's privacy not just while you're living, but also when you pass away. So, if you, and this is really in any state, if you pass away even with a will, generally your estate is probated, meaning it goes through the probate court. And I don't know if you're familiar with probate. You've probably heard of folks going through it. It's generally a pain in the ass, and it can be timely, and it's all public information. So you pass away, and you can go look up in your county. Generally, they have county websites. You can go see who died, what their will said, who it's going to. Rich people don't like that because it puts a target on the back of their beneficiaries, and it opens their estate to being contested. So when it's going through the estate probate process, people can bust in and say, hey, John owed me $300,000 2 years ago, and I know he's dead now, but his estate needs to pay up. And it could be total BS, but the state, the probate court, is obligated to validate that claim against your estate. So they have to open up an investigation, try to determine whether or not there's validity to it, and your estate is literally stuck in probate. And you'll hear of high-profile individuals that you would think have a plan together. I think there's some like, the Michael Jackson estate. There's plenty of them you can Google, but they're stuck in there for years because there's no resolution. And while it's stuck in that process, your beneficiaries can't get anything out of the estate until the claim is resolved. So there's a real need for privacy, not just because it makes sense from an asset protection standpoint, but also when you do pass away, ensuring that your assets go from you to the next generation in a manner that doesn't put a target on the back of your beneficiaries and open the door to potentially contested estates. And one of those vehicles, and I'll just mention it, we won't get into the weeds, is a revocable living trust. That's what helps keep you outside of the probate process when you die. And that particular trust can be set up and changed 1,000 times over if you deem it needs to be changed, whether it's what it holds, the beneficiaries. There's a lot of flexibility there. And when you die, that revocable trust becomes irrevocable, meaning it can't be changed. And that's what keeps your assets out of your estate, because the judge looks at your estate, is like, oh, there's nothing in here. All John's stuff is owned in this trust over here, so I don't need to look at anything. Boom, you're out of the probate process, and you don't have your information, open to the world. So that's just one trust, though, and I'm not going to go through all, of the potential trusts that can be set up here. But privacy is a huge concern, both to the crypto realm and to the non-crypto realm. And there's various structures, a revocable living trust just being one of them, that help emphasize how do you keep your assets private as you off-ramp, and then how do you keep your assets private as they pass down to the next generation. So there's a target kept off your back, and the world doesn't know what you have. The second, cornerstone from an objective standpoint in our planning is asset protection. And I usually ask folks on calls, what does asset protection mean to you? And a lot of folks, for whatever reason, think it has to do with tax, which I love talking about tax. And that's another thing I'll mention later. So I'm a CPA. I've got a master's degree in tax. I'm the tax nerd on the team. And I could spend the entire webinar just talking about tax. And it's what everyone wants to talk about. I'm restraining myself right now so we talk about other things that influence the tax plan. The second thing being asset protection. Asset protection is not about tax. It's about creating a firewall between certain assets that you place in a certain trust and the outside world trying to sue you. So I kind of alluded to this earlier. You get in the fender bender or whatever accident it might be, and you end up in court. And maybe it's some, frivolous, like, oh, well, I just bumped into the car at the red light. Clearly, there's barely damage to the car, but, you find out in the coming weeks that they've hired an attorney. That attorney's found out you own a lot of stuff, and now the situation's exaggerated. Lifetime pain, you're never going to be fully recovered. You need to pay them millions of dollars to make them whole. Those situations don't happen all the time, but they do happen. Frivolous lawsuits affect the high net worth folks of the world, which is why asset protection is so critical. So can we create a firewall between assets that you place in certain buckets, like an asset protection trust, and the outside world? And the answer is yes, you can. And you can put crypto in those buckets. You can put real estate. You can put stocks and bonds, whatever you want. And there's certain rules you have to follow with this particular trust. But once they're in that bucket and you've set the trust up correctly in the right jurisdiction and you administer it appropriately, then there really is a firewall between the outside world and those assets. And that firewall is not just blocking out the folks like, in the car wreck, for instance. We're talking about any creditor. I mean, anyone trying to come after you, even, and this is uncomfortable sometimes, I mention it in meetings out of the gate, ex-spouses. Doesn't work great if you're already married. If you set this up prior to marriage, it's rock solid from a prenup standpoint because it was set up with your money for your benefit. And if you do marry after that and then turn around and get a divorce, very, very difficult for folks to reach into that bucket, even ex-spouses, and take money out. But the trust needs to be set up prior to the creditor existing, whether it's the ex-spouse or the person you hit. Where these vehicles don't work is where you run over someone in a crosswalk and you're like, oh crap, I got to go set this trust up to protect my stuff. That doesn't work, because when you go to lawsuit and to the court and you start litigating this, they're going to see that, oh, I see what's going on. John set this trust up 2 weeks after the incident happened. And that's called a fraudulent transfer. And it completely negates all of the asset protection that we're talking about. As long as the trust is set up prior to the creditor existing or the incident occurring, then it has the benefits afforded to it by the state from an asset protection standpoint. And emphasis on the state. So asset protection, and I'm going to zoom back out here in just a second because we're kind of going down a rabbit hole, but asset protection is not defined by federal regulation. Every state gets to decide how much protection they want to afford this type of trust. And there are certain states like Georgia, where I'm from, that are terrible. Most states aren't great. But then there are a handful of states that have made really progressive legislative changes to protect folks that are setting these vehicles up within those states. States like Nevada, Wyoming, Delaware, Tennessee, Rhode Island, Alaska, just to name a few, are states that have taken really progressive measures to protect these type trusts and really create that firewall around them. And the beautiful thing is you don't have to live in those states in order to domicile a trust within them. So it's another thing we'll talk about is geography is irrelevant when we're talking about asset protection. It might help if you're in the same state we're setting it up, but generally, as long as you set it up, administer it effectively, there's you don't have to live in that state, and you get the benefits that the state provides from an asset protection standpoint. We prefer, and it's the reason why we have our legal team in Nevada, we prefer Nevada's legislation because they've really gone to the extreme from an asset protection standpoint. A lot of those states I mentioned, they're all kind of on the same level from what they consider okay and what they're like, we're not going to protect you against that. They're all, for the most part, and there's some nuances with each state, but all of them outside of Nevada are really kind of on the same, and Tennessee to an extent, on the same playing field. Nevada's gone so far, and I'm not saying I agree with this, but if you have a child support claim against you, a child support claim can't even get into a Nevada asset protection trust that's been set up appropriately. Other states are like, that's a line we're not willing to cross. That, alimony, they all have their individual rules, and a lot of them have, drawn lines in the sand. Nevada's basically washed out all the lines. Like, hey, there's no line. This is, protected to the max. So that's why we choose Nevada, because they've got a really, really reputable and a strong legislative framework to protect folks that set these type vehicles up. So that's the second core objective of what we're trying to institute within the planning is asset protection, that firewall between the assets you throw into this particular trust and the outside world trying to take them, whether frivolous or not. The third, and this is the one I get excited about, is tax efficiency. So being the tax nerd on the team, like I said earlier, I could talk all day about tax savings, tax strategy, deferment strategies. That's my bread and butter along with the trust side of the house. I refrain from talking all day about it and really try to refrain from talking about in too much detail any particular tool, because I don't want the community to get myopically focused on one strategy. And I'll give you an example. Had a conversation with Kinetics and RG3, rewinding a few months back when we first spoke over the phone. And a part of that conversation and describing what we do outside of crypto was, hey, have you heard of a NIMCRUT? Here's what it does. And at that very moment, it was the best thing since sliced bread. It's like, holy smokes, and NIM, you don't have to pay capital gain tax when the trust sells it. And don't get me wrong, charitable remainder trusts are awesome when they're for the appropriate folks. And it's really in line with their goals and objectives. And I'm not trying to take anything away from the benefits they provide. But that situation was literally me and the team just, reaching into like a metaphorical toolbox and saying, hey, here's a screwdriver. And it can do some pretty cool stuff. And not telling you about all the other tools within the toolbox that do other things that are actually beneficial. So that screwdriver is the charitable remainder trust. Screwdrivers are pretty cool. They can do a lot of things, but they can't do what a hammer can or a wrench. So there's other strategies out there other than just this one size fits all charitable remainder trust that come with tax benefits. And we could have a whole conversation just on that, whether we're talking about charitable remainder trust, charitable lead trust, qualified opportunity zones, defined benefit plan, 401ks, deferred strategies from a tax standpoint. There's a ton of different strategies. And out of the gate, we're not going to say, hey, everyone needs to set up all these different strategies because they're all absolutely applicable to everyone. That's not the case. That's why we're not making a video that's just like trying to pump up a charitable remainder trust, because we're not trying to sell you a trust document. You're going to see that a lot on YouTube with a lot of folks that are literally just trying to sell the ink on the sheet of paper. Let me sell you an asset protection trust or a charitable remainder trust. Here's all the cool things it does from a tax standpoint. Slides it across the table, moves on to the next person. I don't know what you need because we don't have all the information on you. But a part of the onboarding process for Mountain Crypto Advisors is a pretty detailed request of information. You're going to go through the initial survey that you fill out on the website, which is really just scratching the surface of what we're going to request. And then we're going to send you another real pain in the ass survey to fill out after the call that goes into a lot more detail and asks you a lot of hard questions, because those questions are critical to ensuring that the trust, the tax plan, the investment, cash flow strategy are all aligned effectively with what you are trying to accomplish. Questions like, hey, this particular trust, do you see it as something that's around benefiting just the next generation? Or do you want it around for generations to come? Because under Nevada law, you can have these trusts set up so that they exist for 365 years. So you don't have to set it up just for the kids. They could literally be a generational trust that's around for the long haul. But that's your decision. That's completely customizable. So questions like that might be difficult to answer, and we'll talk about them. You're not going to be stuck in stone the moment you answer the second survey, but it's information like that ensures that we're tailoring the plan to what you're looking for. So that's really asset protection in a nutshell. Critically important, not just for crypto folks, but the high net worth folks outside of crypto. And it's why we focused on it for as long as we have. The third, again, tax efficiency. I'm kind of bouncing back and forth. Tax efficiency, whether it's a qualified opportunity zone, the charitable remainder trust, we're going to go through the analysis of seeing what's applicable to you. Qualified opportunity zones is something I don't really hear a lot of folks talking about within the crypto realm, but are pretty dang cool when it comes to how to mitigate, defer, and potentially reduce the capital gain tax that you would owe associated with off-ramping from crypto that gets into real estate development. A lot of you all, from my conversations and the team's conversations, are looking for cash flow generating passive investment activities that can either supplement your income or replace, the income from your job. So you can focus exclusively on that and other activities. Those type things can be married up with pretty cool tax incentives like qualified opportunity zones that allow you to roll capital gain into a specific geographic area. There's like 8,600 across the United States, and literally not pay the IRS a penny for about 5 years. So you get to just defer that capital gain. So basically an interest-free loan. And then after the 5-year mark, there's a potential decrease in what you pay the IRS, depending on how you've structured and when you roll that money in. And then if you hold that investment for 10 years, so if you hold it for the long haul, which a lot of folks are in the crypto realm are more long-term looking, especially HEX, I should say. then you don't pay any capital gain tax on the appreciation once you sell it after 10 years. That's a huge benefit for folks that are looking to roll money into potential real estate developments, rental property. There's a lot of rules and regulations around that particular area, but that's another strategy. Aside the charitable remainder trust, which in and of itself is pretty cool. The idea that you can throw assets into a bucket, sell them, and that trust pays 0% in capital gain tax is pretty exciting. And especially if you can marry that up. And I know some of y'all probably watched some of the charitable remainder trust videos online. There's some on the website. So if you haven't checked out the videos on the website, we go over just a few different trusts, not all of them, and explanations there. But this particular trust sells those assets, turns around, pays you income based off of the investment of the cash that's now in that bucket after you've sold the crypto. And then after the term of the trust ends, which can be a fixed number of years if you decide, up to 20, or for the life of you and the spouse if you want. But after that trust ends, it dumps over into a charity or foundation. We set those up all the time, both charities, foundations, charitable remainder trusts, because believe it or not, high net worth individuals outside crypto are really excited about saving money on tax. And honestly, the optics of saying they have their own family foundation. And whether or not, charitable planning's for you or not, you don't have to make that decision now. It could just be that you're doing it for the tax reasons, and that's completely fine. I'd say most folks do it just for that and the income stream that comes out of it. But if you're really looking for the next level, which is like a legacy type planning, the idea of setting up a family foundation or public charity that you, the spouse, are involved in, maybe not right away, but it may be in retirement, getting the kids or grandkids involved in and actually having the potential to pay them as a part-time job. And there's rules there. There's nothing that says you can't do that, but definitely don't overpay them for work they're not doing, or their IRS is going to poke their finger out at you. But you can employ yourself or your kids as long as you're carrying out a charitable intent. So a lot of folks we've worked with now in crypto, there are folks in crypto I've had calls with already that are like, I am absolutely doing that right out of the gate, period. There's folks that are kind of on the fence about it, but it's completely your decision. A lot of folks outside of crypto do it because they want to involve the family in a legacy, something they can leave behind for the kids or grandkids to be a part of, that's charitable, that keeps them involved in something good, and that brings the family together. Again, not something you got to do, but something a lot of folks like. And the idea that you can take that entity and marry it up with something like a charitable remainder trust so that it dumps into that nonprofit or public charity or a private foundation after it ends is a pretty cool concept. But it's not the only plan, is my point. Charitable remainder trusts are like the hot topic right now. And I'm not saying don't do one by any means. We're doing a ton of them for a lot of folks in crypto, but it's not the only strategy out there. And I'm hesitant on going into too much detail because it'll end up like the call I have with RG3 and Kinetic Source, the best thing since sliced bread. And, we're just focused on the screwdriver, not all the other planning strategies that might actually be more tailored to what you're trying to accomplish than a charitable remainder trust. But that third point, that third objective, tax efficiency, is critical. And it's not just tax efficiency as you off-ramp from crypto. Hey, how do we prevent the IRS from getting money as best we can as you off-ramp from crypto? That's the question. There are things that can be done. Staying in the United States, because most folks in the crypto community, and it's just because they don't know that this is their tax plan. It's two ends of the spectrum. It's I'm going to bite the bullet and pay the tax bill, or I'm going to flee the country. It's like the two extreme ends, and it's usually one or the other. And I'm not trying to talk you out of leaving the U.S., but I will tell you there is a lot of misinformation, misunderstanding as to what that means. If you think that the United States government, and I wish this were the case, is as nice to allow you to pick up your bags, leave the country, and not pay them anything with regard to your crypto when you do sell it, this would be a different conversation. I wish they were that nice. But if you think they're that nice, you're living in a fantasy world. They're not. They're trying to get anything they can out of you, even if you try to pick up your bags and leave. And there's strategies to trying to prevent what they get by using these time-tested tools without leaving the country. But we weigh that for folks. I mean, we've got clients in Puerto Rico. We've got clients in Europe, like I was saying. We've got clients all over. And of course, the tax considerations for the jurisdiction you're in come into play here. But it's also, if you haven't made a decision yet, hey, I'm kind of on the fence, fleeing the country, don't think that that's the only option to saving money. There's real ways to save money that's just in that middle ground. And most folks in crypto that didn't grow up in wealth just don't know about it. Unless you're a nerd like me and you're going to pick up a book and read it and learn this stuff, you're not going to know that the middle ground exists. But the middle ground is where the high net worth folks of the world focus, because just paying attention can save you a lot of money in taxes. Just paying attention can really protect you from folks trying to sue you. So that middle ground is exactly where high net worth folks operate day in and day out outside of crypto. All we're doing is saying, hey, crypto community, it's almost like an education process. Here's some options that are outside those two extremes. So again, not trying to talk you out of any plan you got. Just consider all your options and weigh them before you make a permanent decision or one that's going to take up a lot of your resources and time to adjust. And make sure you're interpreting the rules of your departure from the U.S. if you choose to do that correctly, because the wrong interpretation can put you in a pretty tough spot. And I've had some pretty uncomfortable conversations with folks that pulled the trigger going to certain jurisdictions and just didn't have everything in order, and are going to have either a hard fight with the IRS or just a difficult situation trying to unravel that, even if they decide to change their mind. So the point is, there's a lot of options out there. We're going to talk about them. The three core objectives: privacy, asset protection, tax efficiency. Those are the three objectives. We can talk about the 10, 15 different trusts. And I wish there was just one trust. I've said this earlier and on previous calls. I wish there was one trust that did all this stuff. But the reality is there's not. Because each trust that we're going to talk about as part of your plan is built to optimize a particular benefit, whether it's asset protection, privacy, tax efficiency, cash flow generation. And if you combine them, they literally work in conflict with one another from a legal standpoint. So you can't just Frankenstein all these trusts together and be like, hey, I just want one trust. That's it. I want to keep this simple. I wish we could do that, because we love simplicity. We love to just have one trust that does all these things. Unfortunately, from a legal and execution standpoint, that's just not possible. So the question is, what trust do you need to set up out of the gate? That'll depend. It'll depend on what your goals are, what your net worth is, what your timeline to retirement is. We generally look at revocable living trusts, asset protection trusts, and then a variety of other trusts. Those are kind of the two we focus on out of the gate. A variety of other trusts, whether it's charitable remainder trust, lead trust, irrevocable life insurance trust, legacy type trusts, whatever it might be, to create the optimum combination of trusts that meet your goals and objectives. And if you got a smaller bag, like I'm talking to some folks that have under 100 grand, and then other folks that are literally over $1 billion. Like that's literally the range right now, just within the crypto realm, nothing outside of crypto. We've got folks right now with MCA that have under 100 grand and some folks that have over $1 billion. And those conversations are different when we talk about planning. Someone that's got a smaller bag probably isn't going to need out of the gate all the bells and whistles that someone with a huge bag of whale has. And that's okay. We start out by building the foundation, the basic stuff that really answers the questions of what happens if you die, what happens if you end up becoming mentally incompetent or incapacitated, I guess, in the hospital and can't make financial decisions on your own. In those two situations, what is the plan that's in place? That's kind of the foundation. If you die, where's this stuff going, and how do we make sure it goes to the next generation in a private manner, protected and with strings attached? And then if you end up in the hospital and you're, I hate to say this, but if you're a vegetable in the hospital, you cannot make financial decisions on your own. How do we ensure that there's a plan in place to ensure that your assets benefit you while you're living, even though you might not be able to make the decisions on behalf of yourself, and then benefit the folks after you pass away in a manner that is tailored to your desires? So that's kind of the foundation. Those questions should be answered for anyone, whether they've got $10 in their bag or $1 billion in their bag. And that's where we start. Now, building on that might not mean that for someone with under 100 grand, we're doing the same stuff like I was saying for someone with $1 billion. But as their bag grows, as Pulse launches, Pulse X, or just the appreciation of HEX, there's going to be a need for additional planning at certain triggering thresholds. And whether those thresholds are net worth driven, or you had a kid, or you're going into retirement, it's not always going to be cut and dry like a clear line in the sand. But it's one of the reasons why we are involved ongoing, and why it does not make sense for us to just slide across the table the document, the trust, and say, hey, here you go, good luck, because you need someone in the room to say, hey, you've hit this threshold, and we got to really start considering this thing that I know we've talked about before, but we said earlier on it wasn't applicable at the time. We need to start talking about it again. That's why we're involved, is make sure that we build on that foundation as your bag grows, as your life circumstances grow, but also change the foundation as much as we can if the circumstances change. Like I was saying earlier, we're planning on your plan changing. So what your goals right now, your objectives aren't going to be your goals and objectives 5-10 years from now. And you can say, no, they are. Okay. We've heard that before numerous times on the other side of the fence. Yeah, nothing's going to change. I'm really clear on what I want. And maybe that actually turns out to be the case. We're going to plan as though you're going to tell us one thing initially and your life will change in some manner, whether it's having kids and, circumstances change and now you want to change the timeline, or some event in your life changes otherwise that changes your goals, your outlook on life, and what you want to do with this money. That's why we're involved. Amending the plan when it's appropriate based off of your bag growing, life changing, or the SEC, IRS, or some government entity saying something about crypto that affects us all. And making sure the plan is amended so that it's defendable against the folks that honestly are going to be there to try to attack the community at large, not just HEX, Pulse, Pulse X, but crypto in general. And that's a separate conversation. I'll go down a rabbit hole. I'm going to do a live stream with Discourse Syndicate at some point about this topic, this idea of, HEX specifically and the tax interpretation of it. I'll do just a couple minutes here and I promise I'll come back. HEX, as you're probably aware, and I say this on the calls generally, there's a lot of different floating ideas within the community and outside of the community as to how HEX should be taxed. The IRS hasn't said anything about HEX, nothing. And that's probably not a surprise. They've said very little about crypto if you're comparing it to what they've said about other, areas of tax planning. Very little relative to that. They've said some stuff about when, a taxable event has clearly occurred, how mining is treated, paying for services in crypto. So there is some guidance that's pretty, I won't say rock solid, but it's non-debatable really in the eyes of the IRS. And a lot of it makes sense. If you're going from crypto to fiat, the IRS says that's taxable. And it should be. I mean, that's like selling a piece of property and getting cash, right? That's what it is, taxable, just like it is in that situation. Or if you go from crypto to another crypto, if you go from HEX to ETH, taxable. And the analogy there would be selling Apple and buying Amazon stock. And I know obviously HEX, not a security, but same type analogy with regard to taxation. Those two events are clearly in the eyes of the IRS taxable events. Everything else is pretty much a gray area with a bunch of CPAs trying to guess, a bunch of tax attorneys trying to guess what the IRS is going to say before they say it. And it's all guesswork. What's dangerous for the HEX community, and I promise I'll spool it back in just a second, is the vernacular we're using. It's terrible. CD-like. Yeah, let's describe HEX as CD-like. It makes sense conceptually. Terrible idea if we're trying to cage the interpretation of the IRS in the manner that we want. Because guess how CDs are taxed generally? On unrecognized gains. So CD in a bank, it accrues interest, unrecognized gains taxable in that year, even though the CD doesn't end for a few years. That's the last methodology in which we want HEX to be taxed. Literally, and there's some folks out there that believe that to be the case, that HEX would be taxed as it accrues interest every single day. I've had passionate debates with seasoned tax attorneys about it. Now, a lot of them don't understand HEX, and they hear CD-like, they hear interest, and they draw a parallel. Oh yeah, this looks like a CD, should be taxed as a CD. That's dangerous because the HEX community, crypto, is going to be attacked by the IRS. I don't know if y'all are following the Build Back Better Act. Build Back Better Act. It's already approved through the House. It's in the Senate right now. I think they're saying it should go through by April, but the IRS is about to get a hell of a payday. I think it's like $500-600 million to ramp up their auditing department and their systems. And there's no debate as to what they're going after with, I think they said they're hiring like 87,000 new employees. It's in the budgetary report what they're going after, crypto. They're going, and not only are they going after crypto, they've like run these pro formas essentially of what they think they can bring in additional tax revenue by going after crypto. I mean, it's all a scheme to bring more money into the government by going after folks that either aren't reporting crypto gains or misinterpreting the rules around how they report crypto gains. That fight's coming, whether it's this year or next, it's coming. And the HEX community is going to be involved because HEX is crypto. We're preparing for that fight from day one. We are expecting you to get audited. And I'd go ahead and just set your mindset that you are. Statistically, you probably won't, but go ahead and just get in your mind that one day you're going to get a notice of deficiency letter from the IRS that says you owe additional money that was unreported or misreported. That day might come. Just prepare yourself for it and understand that you got a team here to back you up through that painful process. It's going to be painful. There's nothing we can do about that. Working with the IRS always is. But we're starting today and planning for that audit, whether it happens or not. But the danger we're working in now is shaping the community's interpretation and the IRS's interpretation. It's the last thing anyone wants is taxation on unrealized gains. Using the wrong vernacular hurts us because if an IRS shows up on the doorstep, they look at websites, they look at, community chat about HEX, and they start seeing the wrong terms, they're going to draw a parallel from what they do know. They understand CDs, they understand interest, to what they don't know, crypto, and damn sure don't understand HEX. So if you want to paint that kind of roadmap for them to be driven straight to the worst end of the tax spectrum, let's go ahead and keep using words like CD-like and interest, because that's exactly where we're leading that eventual IRS agent that's going to be knocking on the doors of some hexicans probably in the near future. And a hexican's probably going to end up in tax court. So let's talk about how this works. When you get a notice of deficiency, you can appeal it. You can try to justify your position. But generally, in these type environments to where the IRS is making their claim as to how something should be treated from a tax standpoint, your options are pay us or meet us in tax court, generally. Unless there's just some, reporting error that occurred as to why they're saying you owe more. If it's a matter of interpretation, those are generally your options. Pay us or meet us in tax court. So a hexican, I believe, is going to end up in tax court, and that is one of the most important events for the community. And again, I'm going down a rabbit hole, but this is critical, and I'm going to stream about this with Discourse Syndicate, but that interpretation sets a precedent for us all with regard to how future tax will be handled and interpretation of HEX. We don't believe that right end of the spectrum is correct. We tend to lean towards the left end with what we know. If you go from crypto to cash or crypto to crypto, that's taxable. Sacrifices are a little weird. We'll talk about that too, because technically you are going from crypto to crypto, but you're not really going to something that has value at that moment. It's kind of a gray area as well. But we don't believe HEX should be taxed like a CD. We believe it's more like and this is a weird metaphor. It's something I've talked to Funding Jim about, and I tend to agree, is it's more like a damn farm. It's like you're planting a seed in the ground for something that will come to fruition 15 years from now. And it's not like the IRS goes into, an orchard or whatever it might be, pulls out a tape measure and says, hey, this grew a foot from last year. You owe us tax on this tree. They don't do that because the next year a frost could come through and wipe out the entire orchard. So I believe, and I know that's a weird metaphor to draw this to, HEX should be taxed more like that than it should be taxed like a CD, even though we're calling it a CD. So I'll zoom back out. The bottom line there is we're planning for the worst case scenario from day one, that you're audited. We're going to be there through it. It'll be painful. It's not going to be fun, but it's important as a community that we start preparing for that. We use the right words, and this is critical, and then I'll move on to the next thing. We all have a similar interpretation. If you've got a CPA that thinks they understand hex or crypto, they've got their interpretation. You got another Hexican's interpretation that their CPA is using. You got another. When the IRS starts picking at this and they see, oh man, these Hexicans have like 10, 15 different interpretations, it looks like we don't have our shit together as a community. Oh, they clearly don't know how hex should be taxed. So let let them know how it should be taxed. The last thing we want is the IRS telling us how hex should be taxed, because they're probably going to push towards that right end of the spectrum, and we're going to have to fight it. We don't agree with it. We tend to push towards the left end, and we're creating a defendable position around that. There's no guarantees in that. We don't know where they're going to stake their flag in the ground on interpretation, but we're preparing for the worst case scenario, which would be the IRS saying hex is taxed on unrealized gains every single day. Again, I'll have a separate conversation on that. Make some comments in here. I think it's on private setting now. I'm, again, not tech savvy with the webinars, but if you got questions, do you think that message is would resonate with the community? I'll do a stream with Discourse Syndicate. If you think it's something that's irrelevant, then throw that in there as well. I'm all ears, but I see it as the largest risk potentially to the appreciation of hex, because if that interpretation is taken, think about how folks are going to be disincentivized to throw money into hex. New Hexicans, current Hexicans. Think about the whale that's going to get a notice of deficiency letter, and the fact that that bill is going to be so high, they're not going to have liquid assets to pay it. They won't. We're working with a bunch of whales. They believe in hex. They're in hex. They're going to have to emergency instate just to raise the money to pay Uncle Sam. So yes, it would suck for us individually to have that be the case if we were the ones being audited, which could happen, but it sucks for the community because of the interpretation and the downward pressure it really puts, I think, on the appreciation of hex, potentially. So let's put our energy as a community into using the right words, but also taking a uniform approach. It's one of the reasons why MCA does all the tax returns, specifically my company does all the tax returns for MCA clients. We want everyone to look the same. So when we are attacked, we have a uniform front, and everyone doesn't look different and lead to the situation where it's like, oh, we got to tell them how this stuff's taxed because no one has their shit together in this community. There's like 20 different interpretations. That's one of the reasons why MCA exists. Uniform approach, defend our position, and start preparing today for the inevitable fight. I mean, we've got strategies working in the background where we're going out and talking to lawyers already for the future tax court fight that's going to happen. Like that's happening. That is in the process of happening right now, putting folks on retainer so that we can fight the IRS. Because the IRS, when they go to court, they don't bring out the assistant in the back. It's like, hey, Johnny's not paying up. Let's go get this guy. That is not what happens. They go out and they hire top talent outside of the IRS to fight you. Folks that understand and can poke holes in the right areas and know how to poke holes in it because they understand crypto, or at least understand what they think they should say to make the judge think they understand crypto. That happens, and they've got a big ass checkbook to make that happen. So they can't hire, though, attorneys that have a conflict of interest with them. And a conflict of interest exists when an attorney is representing the person that they're trying to sue. So we are in the background putting together an all-star team that is there for you, the hex community. I'm not saying it'll be free. Like, these lawyers are going to cost money if you decide to go to tax court, but at least the community, have top-notch, kind of the all-star team picked out, prepped and ready to go before the eventual Hexican even gets the notice of deficiency letter, so that court case that takes place inevitably, I believe, sets a precedence that's positive for hex rather than negative. And we can use that against the IRS in the future. So I just went down a deep rabbit hole there, and I'll zoom back out. But that should show you how involved we are in this community. There is no one on this planet within our realm of planning that has developed a company for crypto by crypto, that has literally made the crypto we're talking about, whether it's Hex, Pulse, PulseX. And I'm not saying Ethereum, Bitcoin, these other cryptos, are unapplicable. A lot of the stuff we're doing can be applied to any crypto, but we've literally built the company around this community because a Hexagon showed up on the doorstep 6 months ago, which is kind of insane. Again, whether it's coincidence or fate, I'm not sure. But zoom back out. So 3 objectives we're trying to accomplish: privacy, asset protection, tax efficiency. It's more than that, though. Once you off-ramp and you have cash in the bank, the question is, what the hell are you going to do with that cash? So it's, we got to create a cash flow strategy. How are you going to deploy that money in a way that makes you money? And I get really excited talking about this. I want you to listen to the folks in Discourse Syndicate. Kinetics, Whales Only are going to talk about this. RG3, I'm sure they'll all bring it up. I think Kinetics has brought it up a few times. That's why I mentioned his name. There's going to be opportunities for folks to invest in private investment deals that focus on passive income strategies. And that's a decision you get to make as you off-ramp. Those type deals will only be available to accredited investors. Accredited investors are folks that have generally over $1 million in net worth, excluding their primary residence, or they make a few $100,000 each year and have for the last few years. If you're accredited and crypto counts towards that net worth, you can participate in investment deals that the general public cannot. And the reason why they can, it's not our rule, it's the SEC's rule. And it dates back all the way to 1933 with the Securities Act. It basically says, hey, if you're a company trying to raise money, you can't go out and ask folks for money without following all these rules that get into an initial public offering, an IPO. And we've helped companies do IPOs. They're a huge pain in the ass. You're talking millions of dollars in legal fees. I'll get into this later on the public trust. But we've done that before. It's a huge pain. No one wants to do it unless it makes sense. Apples of the world, Amazons of the world, yeah, it makes sense for them. But for an investment deal that's going out and building a condominium development on a beach in Miami, or an apartment complex, or storage units in a downtown area that's just going to print cash flow, those folks don't need to go through the expensive process of doing an IPO, all the legal fees and the timeline. So the SEC made a exception to that pretty hard rule that you have to do an IPO to go out and ask folks, for instance, in the crypto world, for money for a business. You can do an offering under Regulation D of the 1933 Securities Act. And Regulation D says you can go out and talk to folks about raising money, but they need to be folks that are able to take some risk. And we, the SEC, believe folks that have a net worth above $1 million minus their primary residence can take that level of risk, not have to go through the IPO process. And those folks are considered accredited investors. So if you hear that term, that's what that means. Accredited investors within the MCA realm will have the opportunity to invest in similar things I was just mentioning. Hey, you just off-ramped $500,000. Let's talk about where that money goes. You want to buy this? Okay, here's how much money's left over. How do you want to deploy that? Here's some investment opportunities of teams we vetted outside of MCA that are doing developments all over the country. The condominiums in Miami, the storage unit developments, solar power plants. Here's a startup cannabis company. Here's a tech company that we're looking at buying. And you get to say, hey, that's pretty cool. I want to put a little money in that, own a piece of that company. Or, I like these two, but not those. Or they're all dumb. I want the money to go in my trust and make money. You get that decision. We're there to take the teams we've worked with for a long time outside of crypto, because the billionaires I'm telling you about, the deca millionaires outside of crypto, they do that stuff all the time. They're constantly building solar power plants, apartment complexes, things that generate cash flow. And they have development teams that they work with, that we've got connections with. And we're going to bring that to the table to say, hey, here's folks we've vetted. Here's their team. Let's introduce you to them. Here's what they're trying to do. Here's what they think it can make. You get to make the decision. And that decision could be, I like this one, hate the rest, hate them all, or love them all. I want to put a little bit in each of them. And you're going to have your own company. And again, you're probably like, some of this is, I know the first time I'm saying it, you're like, what? I'm going to own a company. Yeah, you're going to have a company that owns your crypto. This will go into a discussion on the architecture of how all this stuff fits together, which I'm not trying to make this call about. You're going to have a company that you control that owns your crypto. And when you partake in these different, investment deals, your company will own slithers of various companies. And when they make money, it's going to push up to your company that is then turning around and paying your trusts or you directly. We'll talk about that in more detail, but that's kind of a high level of how the architecture works. But again, only available, that particular private offering, only available to accredited investors, but your crypto does count. So you might not be accredited now, but you fast forward, 6 months and you're looking at where Hex is then, Pulse X, and that could be a very different story. But again, not something you got to make a decision on out of the gate. Those will be conversations we have as you're off ramping, whether it's, hey, you got a big ass stake coming due, or hey, Mountain Crypto Advisors, I'm thinking about taking out, 500,000 from Pulse after it launches. Okay, let's talk about that before you make the decision. Once you make the decision and you off ramp to cash, if you don't have the plan set up, and this is kind of a sidebar, but this is important to understand, if you don't have the structure of what we're talking about set up and you sell out of your crypto, a lot of the tax planning strategies that I'm mentioning are out the window. But you just can't do them because you have personally already recognized the gain. There's certain things you can do still, but a lot of them, for instance, the charitable remainder trust, there was not this idea to where you can sell out, you got cash in the bank, you're going to set up the trust, you're going to move the cash into the trust and avoid paying the capital gain tax on the sale of the crypto. Nope. I've actually worked with folks outside of the crypto community that thought it worked that way with their previous advisor. Advisor didn't tell them it was real estate. They had a huge plot of land. They actually set up the charitable remainder trust. They didn't retitle the property in the name of the trust. So it wasn't the trust that was selling it. It was still in their names. So they sold it and then same day moved the cash into the trust, owed capital gain tax on 100% of it. This happened before they were clients of ours on the other side of the fence, but it was a nightmare situation. There was literally nothing they could do. It was not, the trust did not sell it. Therefore, they owe tax on it. So don't make large decisions on off-ramping before you've got the plan set up, because the implication is you might not be able to avoid the tax that you're hoping to avoid. And you're not going to get the asset protection or privacy as you start rolling that cash into different assets once it's in fiat. So again, hopefully that's painting a picture, but it's more than just privacy, asset protection, and tax efficiency. It's also, hey, what's your cash flow generation strategy? That's your decision, but we're just going to give you options, whether it's investment deals you take part in, or hey, all that stuff's boring, throw it in my trusts. And then once the cash is in the trust, whether it's a revocable living trust, a asset protection trust, charitable, whatever it is, any of the flavors of trust, it's going to be invested. And generally in something that's conservative, although that's your decision, generally we use what's called an overlay strategy to enhance income production. And we take a conservative approach to the investment strategy because of all the risk you're taking outside of those trusts. Same thing I was saying before about folks on the other side of the fence that are high net worth outside of crypto. They take a ton of risk in their day-to-day business lives. Hey, you're taking a piece of the profit off the table. Let's diversify your risk so that it's not super volatile, like what you're used to. Now you can say, no, I don't want anything to do with that. I want it all in these startup businesses or, storage unit developments, whatever it might be. And that's your decision, but we'll be in the background saying, hey, this is what it looks like if you make this decision, pros and cons. Here's what it looks like if you want to make this decision. And if you do this, here's how we implement an overlay strategy over what you've got in totality to create an income stream for you moving forward, both currently and in the future. Hopefully that makes sense. That is really in a nutshell what we are trying to accomplish. And I'm purposefully trying to not go into the weeds of all these different trusts because it'll get complex and you'll leave here with a bunch of technical knowledge, but maybe not understand how all it comes together from an objective standpoint. One of the last things, and I'll try to wrap this up here in the next 10, 15 minutes. This isn't just a plan for your crypto. This is not a, hey, let's figure out how to plan with crypto. We're going to ignore everything else. This is a plan for you and your family. It's a plan that accounts for businesses that you might own, trusts that you might already have set up. There's folks that come to us that think they have the entire plan already set up. Like they've got the will, all these different trusts, and we go through it, and sometimes they're good. Most of the times they're domiciled in the wrong state. They're not tailored to crypto. But there's folks out there that believe, oh, I got my team, I'm good. And if you're arrogantly thinking that, then yes, if you're confident you got the team, then by all means go. But there's a lot of folks that want a second opinion for all the work that's been done, and they throw it across the table. And there are very clear things that have not been implemented into the plan. Most of the time, folks are on the other end of the spectrum. Most of y'all don't have a will set up, let alone a trust. Not all of you, but the majority, I'd say, based on the calls that we've had, have literally zero planning done, let alone maybe a couple years of taxes not filed. And that's okay, but we got to get moving on getting your situation cleaned up and getting that basic blocking and tackling type planning done, so you've got the foundation built that you can build upon in the future. But those folks that come to us with no plan is really just starting from scratch, which is sometimes better than folks coming with a full plan that they think is good. Either way, we're going to look at what you got, whether a current plan's in place or no plan, whether you own a business or you've got a W-2 job, and we're going to make sure everything is synchronized into this plan. Because again, it's not a plan just for crypto. It's a plan for you and your family that is very mindful of crypto, which is the differentiator here. Is you can find folks to try to create the crypto plan around assets that aren't crypto, but that's what makes Mountain Crypto Advisors special. Is we're taking that crypto technical knowledge planning piece and integrating it into the rest of your planning across your life. So you've got a really synchronized, holistic plan across all these different areas. And that's what it is, a one-stop shop for all of that. And the reason why it is that way, both here and on the other side of the fence, is because billionaires don't go out, and I may have said this before, but billionaires don't go out and try to cherry pick a CPA, a tax attorney, a insurance guy or girl, the investment advisor, and like Frankenstein them together. Hey, I want to introduce all y'all. I really want y'all to communicate and make sure you put my plan together in an efficient manner. I wish that reality worked, because it'd make my life a lot easier when I'm interacting with folks outside of our team, but it doesn't work that way. You got folks that are intimidated to talk to other professionals because they view it as a potential loss of a client, or just not receptive, or just don't understand it and try to roadblock stuff purposefully. Billionaires don't do that because it doesn't work. Billionaires find teams that are integrated across the board to carry out their planning. So everyone is on the same page, and you don't end up with siloed plans. Like you go out to a farm and you see the big silos. That's what happens. You might find a really smart CPA that actually understands crypto, and then even more understands Hex and has the appropriate interpretation. But even if you find that CPA and you find the attorney at the same level, which good luck finding them, but they probably exist out there. You could go find all these people individually. Rarely, I've never seen it happen effectively, do all those individuals communicate so you don't have a bunch of individual plans. The tax plan that's not mindful of the legal documents, the legal documents that aren't mindful of the cash flow strategy on the investment side, all these things that have overlap and have to be overlapped in order to be holistic. You end up with a bunch of siloed plans that might be great in a vacuum, but when you zoom out and you're looking at the bigger picture, they're not all integrated. So that's what we're the integrators. We're the quarterback for all this different planning to ensure that it's integrated effectively across all these disciplines. That's what we are in the nutshell. Let me wrap up by just saying a couple things as far as how this works going forward, just so the community has an idea of our expectations, and you've got an idea of how you integrate into the team if you so desire. The first thing is that we are pretty dang selective with folks we bring on, and the reality is because we got more folks to service than we can possibly service. We have not set up Mountain Crypto Advisors out of the gate to service every single hexagon. I wish we could. We're not doing that. We're not sacrificing quality of planning for quantity of clients. So that is a line we drew in the sand. Now, I believe that line will be pushed farther and farther to the right as we integrate into the community more and grow capacity. But out of the gate, and it's not like a defined number. We don't know right now how many we're going to take on, but we're not taking on everyone. It's exclusive. And we're pretty picky in ensuring that on that initial consultation call, that we're philosophically aligned. And if we're not, it's perfectly fine. It's not us giving you the middle finger by any means. We're just being honest. Hey, we don't think we're a good fit. And if we get into this, it could be painful if you don't realize after all this work we've done and energy that's been put into it on your part, on our part, you don't value it. You don't see the value. If you just want the ink on the sheet of paper, go hire the YouTuber that's trying to sell a trust document. Go do that. Go hire the local attorney. We are trying to bring to the world of Hex and Pulse the team, not the product. Of course, there's products involved, but we are the team. We're not taking everyone. We'll eventually scale that out. So the initial consultation call, which is really the next step if you are remotely interested in what we're talking about, you're going to talk to more folks than just me. I'm the tax nerd on the team kind of leading this effort, but there's a lot of other folks in the legal realm, in the investment realm. I mean, it's a very large team of experienced folks that are got decades of experience in other disciplines that aren't really mine, that are integrated into the team. You're going to speak to them and get to know them and what they're doing in your planning. If you're at all interested in what we're talking about, the next step is setting up an initial consultation call, which I don't know that you can set one up in between now and March. Like I think literally the calendar is booked out until then. I could be wrong, but that's the next step, setting up an initial consultation call. That call will be more focused on us getting to know each other, whether it's you and I talking or another member of the team, just getting to know you and your objectives and planning goals, and really giving the opportunity for you to ask really specific questions about your personal situation and make sure that you're compatible with us and vice versa before we move forward and get serious about the relationship. And then from there, we have a really dedicated, once you've made the determination to come on, we have a dedicated call that gets into the planning. I was alluding to this earlier, the questions that we're going to send you, the documents. We're going to request a lot of stuff from you that we're going to analyze. Of course, we're going to do your tax returns. And really, I think that should be the impetus of the community. Like, hey, we need a uniform approach in tax interpretation, like I was saying. So all that is going to be a part of what we provide. The next step, though, is getting the call set up. You set up the call, and that is the first step in you making a decision after that call as to whether or not we're the right team for you, but also getting your taxes done correctly and uniform with the defense that we are creating. And once you've set that call up, even if it's in March or April, I don't know how far you'll have to go out, but we're going to send out an email to you and the folks that have set up calls currently to get the ball rolling on your 2021 tax preparation. Yes, we're going to look at previous years. We originally said we're not doing previous year tax returns from a bandwidth standpoint. We're focused on 2021 going forward. But we don't want CPAs, non-tax professionals taking the wrong interpretation in previous years that we can actually affect right now by being involved in the tax filing, and then us taking the appropriate NRS interpretation. And again, you can weigh in on this. I'm just telling you where we stand. We're on the left side. Is there some risk with that? Yeah, but there's some risk with anywhere. We don't know what the IRS is going to say, but we are taking a position that we believe is defendable, and we are creating a defense around it. And we don't want your 2019, 2018 tax returns to be in conflict with that if we can help it, if they haven't been filed yet. If they have, we'll make sure to work around that to make sure that it seems seamless in how we're going from 2020 to 2021 and so on and so forth. But we originally said, hey, we're not doing tax cleanup, but it's clear y'all need some tax help for previous years. A lot of folks haven't filed in, some folks 7-8 years. So that's not something that will happen overnight. We'll focus on getting 2021 done. And you'll get an email once you set up a consultation call to get that ball rolling even before the consultation call happens. We'll get the ball rolling because we can't wait until March, April to start prepping your tax return. We need to start getting information now. So look out for that email once you set up an initial consultation call, probably come out in the next week or two. And that will be a really, indirect way of getting started. It's not a commitment, but the assumption is that you're at least interested in moving forward with the MCA. You haven't made a decision yet. You haven't had your initial consultation call. and we're comfortable getting the ball rolling for you on the tax prep. So we pretty much said we're only doing tax returns for folks that are MCA clients. We'll still do it, even if after the call you're like, oh, I'm looking for a transactional person, because you signed up for the initial consultation call. We probably just won't be doing it ongoing. So point being, initial consultation call, that'll get the ball rolling on getting you sequenced into making a decision. And then from there, we'll get the ball rolling on your tax prep, so we can make sure it's aligned with the position that we are creating a fortress around from a defendability standpoint to fight the IRS and the inevitable case that's coming, and not wait until the last minute to start your 2021 tax return. So that's really it. Last thing from an expectation management standpoint, obviously I mentioned the calendar is booked up. The phones are really ringing off the hook from all over the place. But more importantly, once you're on the call list and we have the initial consultation call, this planning doesn't come together overnight. So please don't leave here thinking that, oh, I set up a call in on March 1st. We're going to have the call on March 1st. And by the next week, you're going to have trust documents ready to sign. No, it won't happen that way. These trusts, if you want a really crappy trust, yes, we could do it. We could click print on the template that comes out of the software like other attorneys use and slide it across there and say, hey, here you go. Good to go. It took us a week. But if you want the trust to be effectively tailored to what you want and desire, it takes time. And right now we're looking at 4, 6, maybe 8 weeks to turn around the full plan. That depends on complexity. It depends on how receptive you are to getting us information, because we're going to need information from you. And it's kind of going to be a pain in the ass. We're going to ask you for the survey, previous year tax returns, all kinds of stuff to make sure that what you're signing is effectively tailored to your goals and objectives. So don't expect, please, that it's going to happen overnight. It's a process, and we view it as never complete. Even though we'll get to a complete status within 4, 6, 8 weeks, it's going to be changed over time. Like I was saying, it's going to be updated. It's going to be added to, based off of changes that we don't know are coming down the pipeline. I want to wrap it up. We're about an hour and a half in-ish. I don't want to draw this out too long. I'm hopeful that this was helpful for you to gain an understanding of, again, who we are as a team, how this came to be, what we're trying to accomplish, so that you can make an informed decision on whether or not we're the right team for you. I do want to do with other team members more webinars that will be more myopically, focused on particular tax planning strategies or trusts, or conversations like we were talking about with the tax interpretation of HECS. We'll get those rolled out in the next few weeks and kind of get on a battle rhythm of rolling those out every other week or so, or at least that's the plan. But for now, hopefully this was a good overview of what MCA is and what we're trying to do. If you've got any questions, again, please throw them in the question section. I guarantee you we won't get back to you probably today, or I don't even know, maybe this week. Like, it's been nuts. But we'll try to get back to you with any questions you've got. Throw them in there. Any outstanding questions that are more technical, we'll reserve for the consultation call, so that we can really dive into technicalities there. So please don't get offended if you don't get a response to your question. It's nothing personal. We've literally just got the phones and the email blowing up, and we're trying to get folks onboarded right now and planning done for folks moving forward. Great getting to speak to y'all. Look forward to future conversations one-on-one, but also in these type settings. Thank y'all. Take care.